Welcome to this deep dive. We're looking at a complete trading system today, one shared by Miss Mansi.
Right. The goal is to sort of unpack it. Yeah.
Yeah, exactly. To
But-
pull out the core principles, give you some actionable steps, for navigating stock trading if you're starting out, or maybe just refining your approach.
And looking at a full system like this is helpful. You see how entries, exits, risk management, how it all connects.
It's the whole picture. We've got her entry strategies, the conditions needed, how to manage trades on different time frames, intraday, swing, longer term.
And things like position sizing, targets, stop losses. It's quite comprehensive.
Definitely. So let's jump in. How does she suggest actually buying a stock? She gives three main ways.
Okay.
First up, breakouts. But importantly, she says the safer ones happen after consolidation.
Ah, right. So not just any breakout needs that sideways movement first.
Yeah, like three or more candles trading sideways. It suggests, well, a pause before a potential move.
That makes sense, like a pressure buildup. Okay, what's the second way?
Buying at support. Here you're looking for specific bullish candle patterns.
Like a hammer or bullish engulfing.
Exactly those. And the trigger isn't just seeing the pattern, it's when the price moves above the high of that bullish candle.
Got it. So confirmation is key. And how do you find these support levels?
She mentions a few tools. Trend lines, moving averages, the super trend indicator, or even just simple horizontal lines if the stock's range-bound.
Okay, options there. And the third entry method.
This one's for more experienced folks. Buying in extremely oversold conditions.
Ah, okay. Requires a bit more judgment, perhaps.
Yeah, she specifically says 3+ years of experience, and you absolutely need confirmation, like seeing a higher high and higher low wave start to form, not just buying because it looks cheap.
That's a really important distinction. Oversold can get more oversold without that confirmation. It's a good warning.
Totally. Now, across all three methods, two conditions must be met, no exceptions.
All right, what are they?
First, volume confirmation. The move needs to have conviction behind it.
Makes sense. Low volume moves can fizzle out fast.
And second, the stock price must be above its 200-day simple moving average.
The 200 SMA. That's a classic long-term trend filter, isn't it? Basically, trade with the main tide.
That seems to be the idea. Okay, so entry covered. What about managing the trade once you're in? This varies a lot depending on time frame.
Right, you wouldn't manage an intraday scalp the same way as a long-term investment.
Exactly. So for intraday quick trades, in and out, same day, the max loss per trade is tiny, 0.25% of your capital.
Wow, very tight control.
And she suggests no more than 2 such trades a day. Targets are small too, like 0.5% to 1%. You'd use maybe the 1-hour chart for the trend and the 15-minute for the entry signal.
High frequency, low risk per trade. Okay. What about swing trading? Holding for, say, a few days to a few weeks.
Right, for swing trading, the max loss per trade goes up to 1% of capital, and you can have up to 7 positions open at once, including any positional trades.
Okay, slightly bigger risk, managing multiple positions.
Targets are wider too, around 3% to 5%. And for time frames, think daily chart for the overall trend, maybe 1 hour for the entry.
That seems logical for capturing those multi-day swings.
Then there's positional trading, holding longer, maybe 3 weeks up to, say, 8 weeks, 2 months or so.
Okay, extending the duration again.
Max loss is still 1% per trade. Open position limit is still 7 total, shared with swing. But the targets stretch a bit, aiming for 3% to 8%. Daily chart for trend, maybe 2 hour for entry.
Got it. Slightly bigger reward potential for the longer hold.
Moving further out, long-term trades. Holding more than 2 months up to a year.
Okay, now we're talking significant holds.
Here, the max loss per trade jumps to 7%, but you limit your exposure maximum of only 4 such positions open.
Ah, interesting. Higher risk per trade, but fewer trades overall. Protects capital that way.
Exactly. Targets are 8% to 20%. And you're looking at the weekly chart for the main trend using the daily chart for your entry timing.
Weekly trend.
Yeah.
Definitely focusing on the bigger picture there.
Finally, there's investing. Holding over a year. She calls these stocks you will not sell lightly.
So a different mindset entirely.
Absolutely. The focus shifts. At least half your allocation here should be in ETFs or very large, stable companies. And you don't sell based on a price target.
Right, so what's the exit trigger then?
A fundamental change. Something shifts in the company's story or the ETF's structure, whatever it might be. Time frames. Monthly for the trend, weekly for entry. Target is just, well, over 20%, ideally much more over time.
Fundamentally driven decisions for the truly long term. That makes sense.
Now, through all these different styles, intraday, swing, all the way to investing. There's one rule about stop losses that applies universally.
Oh, yeah. What's that?
Your stop loss should always be placed at 2 times the average true range, the ATR, away from your entry point.
Using ATR. That's smart because it adapts, right? Volatile stocks get a wider stop, quieter stocks get a tighter one.
Precisely. It builds in a consideration for the stock's recent behavior.
So it's not just a random percentage, it's tailored to the stock's volatility. I like that.
Yeah, me too. So, wrapping this up, what Miss Mansi provides is a very structured way to approach things. Specific entries, breakouts, support, oversold, but always needing that volume and 200 SMA confirmation.
And then this really clear framework for managing risk, adapting your position size, your loss limits, based entirely on how long you plan to be in the trade.
Right. All underpinned by that ATR-based stop loss for protection.
It really highlights how risk management isn't one size fits all. You tailor it to your strategy and time frame.
It's a great takeaway. This deep dive gives you, the listener, a concrete system to think about. Maybe not to copy wholesale, but to see how structured rules for entry, management, and risk can work together.
Yeah, it offers a solid starting point, or maybe just some ideas to test against your own methods.
Which brings us to a final thought for you to consider. How much difference could applying a consistent set of rules, maybe not these exact ones, but your defined rules actually make to your trading over the long haul?
Yeah. What elements from a system like this might prompt you to make adjustments, however small, to your own approach? Something to chew on.